Hey everyone, and welcome back to Zero to Exit. Let's be honest. Does it ever feel like the tax system is designed to benefit everyone except you? Like the rich are playing a completely different game with a set of rules you don't even know exist? Well, in some ways, that's true. But here's the good news. The system isn't completely rigged. There are actually some perfectly legal, legitimate strategies the wealthy use to minimize their tax burden that you can start leveraging. Today, we're not going to be talking about shady schemes or tax evasion. We're diving into 5 legal tax loopholes that, while often associated with the wealthy, can be adapted and used by anyone, even if you're a salaried employee. These aren't get-rich-quick tricks. They're about understanding the rules of the game, so you can keep more of what you earn and accelerate your journey to financial independence. So, let's break down these loopholes, starting with number 1. Loophole number 1, the home office deduction. Now, I know what you're thinking. I rent a small apartment. This doesn't apply to me. But it might. If you're a freelancer, consultant, or even a salaried employee who regularly works from home, you might be able to deduct a portion of your rent, utilities, and other home-related expenses. The basic idea is, if you use a part of your home exclusively and regularly for business, you can deduct expenses related to that space. It can be a dedicated room, or even a clearly defined area. You can then deduct a percentage of your rent/mortgage interest, utilities, insurance, and even depreciation if you own the home. Here's how this might work for you. If your employer requires you to work from home, or you run a side hustle that you operate from your residence, calculate what portion of your apartment or house you use exclusively for these activities. Let's say it's 10% of your total space. You can then deduct 10% of your eligible expenses, potentially saving thousands on your tax bill. This is not limited to doing business. Even if your employer makes you work from home, you are eligible for this deduction. Important disclaimer: tax laws vary, so consult a qualified tax professional to ensure you're eligible and following all regulations. This is not financial advice and is only meant for educational purpose. Loophole number 2. Investing in tax advantage accounts. This isn't exactly a secret, but it's shocking how many people aren't fully leveraging the power of tax advantage investment accounts. In India, we have options like the Public Provident Fund (PPF), the National Pension System (NPS), and equity-linked savings schemes (ELSS). These accounts offer different tax benefits. Some offer deductions on contributions. Others offer tax-free growth, and some offer tax-free withdrawals in retirement. The key here is not just investing, but being strategic about where you invest to minimize your tax liability. Maxing out your PPF contribution, for example, not only helps you build a solid retirement nest egg, but also reduces your taxable income for the year. And for NPS, there are additional deductions available beyond the standard limits, particularly for self-employed individuals. ELSS funds offer the shortest lock-in period among tax-saving investments, making them attractive for those who want to save on taxes while still having some liquidity. However, be sure to choose your ELSS funds wisely, focusing on low-cost, well-managed funds with a strong track record. Loophole number 3. Strategic charitable giving. Now, this isn't about writing off a few hundred rupees you dropped in a donation box. This is about being strategic in how you give back to society, while also reducing your tax burden. In us, donations to recognized charitable organizations are eligible for tax deductions under Section of the Income Tax Act. The amount of the deduction can vary depending on the organization, but it can reduce your taxable income. The key here is to be selective in which charities you support. Choose organizations that align with your values and have a proven track record of making a real impact. Also, keep proper documentation of all your donations, as you'll need it to claim the deduction. And remember, charitable giving isn't just about cash donations. You can also donate goods like clothing, books, or even use electronics to eligible organizations and claim a deduction based on their fair market value. Loophole number 4. Business expense deductions, side hustle. This is where having a side hustle or small business can become incredibly valuable from a tax perspective. You see, if you're running a business, even a small one on the side, You could deduct a wide range of expenses that are ordinary and necessary for running that business. This can include things like office supplies, software and subscriptions, marketing and advertising costs, travel expenses if related to your business, training and education. The beauty here is that these deductions can significantly reduce your taxable income. Let's say you earn $1,000 from your side hustle, but you also have $300 in legitimate business expenses. You only pay tax on the remaining $700. The key to making this work is meticulous record keeping. Keep all your receipts, invoices, and other documentation, and be sure to separate your business expenses from your personal expenses. Loophole number 5, investing in real estate. This is a classic wealth building strategy that also comes with some significant tax advantages. Real estate offers several potential tax benefits. First, you can deduct expenses related to owning and managing a rental property, such as mortgage interest, property taxes, insurance, and repairs. Second, you can claim depreciation, which is a deduction for the wear and tear on the property over time. This allows you to offset some of your rental income and reduce your tax liability. For example, if you buy a rental property and generate 2 Indian rupees lakhs in rental income, but you also have 1 Indian rupee lakh in deductible expenses and 50,000 Indian rupees in depreciation, you only pay tax on the remaining 50,000 Indian rupees. And depending on your tax bracket, that can save you a significant amount of money. Of course, real estate investing isn't without its risks and challenges. It requires significant capital, and it can be illiquid. But if you do your research and invest wisely, it can be a powerful tool for building wealth and minimizing your tax burden. So, there you have it. 5 legal tax loopholes that the wealthy often use, but that you can start leveraging too. Remember, this isn't about cheating the system. It's about understanding the rules and playing the game strategically to keep more of what you earn. But before you go implementing any of these strategies, be sure to consult with a qualified tax professional to ensure you're eligible and following all the rules. This is educational content and should not be construed as financial advice. If you found this video valuable, be sure to hit that like button, subscribe to Zero to Exit, and ring that notification bell so you don't miss our next deep dive into building financial independence. And if you have any questions or other tax-saving tips, share them in the comments below. Until next time, keep learning, keep building, and I'll see you on the path to financial freedom.